Welcome to How to Build a $10 million Net Worth Through Real Estate. If you've been wanting to get involved in real estate, either as an owner or as an investor, you're absolutely in the right place. And by the way, there's going to be nothing to buy in this presentation today. This is an informational presentation, and I'm hoping that it's going to blow your mind and make you go, hey, you know what? I think I want to talk to that Pete guy and see how these ideas and concepts can play out for me. And that's really all I've got for you here, some information. And then at the end, I'll invite you to set up a quick little informal chat with me for those of you that want to take things to the next level. But you're going to get a lot of great information out of our time here today. Now, just a little bit about myself. I entered into financial planning in 2000. I've authored or contributed to 6 different books. There's 4 of them right there. The New Mortgage Investment Advisor, Modern Day Heroes, Lead or Fail, The Leadership Journey. By the way, the New Mortgage Investment Advisor is a little bit dated at this point, so don't go run out there and buy it. I actually need to update that book for what's been happening lately in the markets. I started Pete Mitchell Inc. It's a California registered investment advisor in 2005. And what that means is I helped people with their retirement planning. Now, in full disclosure, I closed down the company in 2016. And part of the reason for that was over all of those years, I began to discover that there were far better and far safer ways to invest for retirement than in the stock market. Now, that's not to say that I don't still have money in the stock market. I do. However, I have a very small portion of my personal net worth in the stock market. And part of that is going to be because of what I'm going to show you here on today's presentation. But I just want to give you that background that I'm very well versed in the stock market and how it works, because as a registered investment advisor, I mean, that's what you do. You're helping people with their retirement plans all day long. But I never was taught about how real estate really works until a man by the name of Mark Prather showed me how. Now, Mark, just to give you a little background on himself, Mark is the founder of Mark One Mortgage and Mark One Real Estate Wealth Academy. He's authored 3 books. The most important one for what we're talking about here is Why the Rich Stay Rich and the Poor Stay Poor. He's been interviewed on various TV and print organizations, mainly because he really understands the real estate and the mortgage markets. And he and I met years ago as I was a financial planner. And a lot of what we did was helping people properly manage the equity in their homes. And so a lot of the guys on his team, the guys and gals on his team, were helping us with our clients. And that's how he and I really became friends. And this is probably back in 2006, right? Shortly after we started Pete Mitchell Inc. And what I'm going to share with you today is a lot of what he has taught me. And I'm very proud to say that I partner with Mark today and work with him hand in hand with all of our clients. And he's been in the business since 1977. So this isn't his first day or his first month in it, right? He's been in it for a while. So let me start off by saying, what do you believe is possible for your life financially? Odds are what you believe is a long way from what's possible. Let me show you what I mean by that. This is the wealth crisis in America today. The top 10% own 90% of the wealth. Like if we look at this chart here, the light blue line is 2016, the last time that we've got data for, versus the dark blue line, 1989. But one of the things that you can see here is the bottom 90% in all the categories owns the least amount of the wealth. They only own 10% of the wealth in America today. It's that top 10% that own 90% of the wealth. And that's really important to understand, because if you want to be financially secure, not necessarily that you want to be wealthy, though I think, on some level we all want to be wealthy. It's just a matter of, do we believe we can be? But we believe we can be financially secure. And that's what we're going to be talking about today. How do we become financially secure? Well, there's 3 secrets to growing your family's wealth. Secret number 1, you got to grow your wealth on autopilot without saving money. Now, right there, I'm willing to bet that you might have just said, okay, Pete, this is baloney. You can't grow wealth on autopilot without saving money. Well, I'm going to show you what I mean by that. And again, you're going to get a lot of great information out of our time here today. Secret number 2, the little known 5 financial advantages of real estate and how you can benefit from those 5 financial advantages. And secret number 3, maximize the safest investment you can make, which is real estate. Now, let me ask you this question. What does it mean to be financially secure? I know for a lot of people, we think, well, the financially secure people, there's the people in the big house, they got the nice car, they got the fancy clothes. But really, those are just things, right? It doesn't mean that person is financially secure. It means they were able to get into those things. Sometimes it's a lease. Sometimes, they've got a huge mortgage and they're struggling to pay it. But it doesn't mean they're financially secure. Sometimes when we look at being financially secure, we go, oh, well, it means you have a big savings account or a big 401k. But is that really financial security? Let's ask ourselves, what do the wealthy believe it means to be financially secure? Let's put ourselves in their shoes. What are they thinking it means to be financially secure? The wealthy are financially secure because they have passive income that comes in month after month with little to no effort on their part. Think about that. Let me say it again. They have passive income that comes in month after month with little to no effort on their part. That's passive income, right? It just comes in no matter what they do. They could be sleeping. They could be on vacation. But the money keeps coming in. That's financial security. That's what I'm going to show you in our presentation today, how to achieve. So secret number 1, grow your wealth on autopilot without saving money. Balancing your lifestyle with saving money is really difficult for most people, right? We've got a life that we need to live. And we need to save this money in our minds. That's how we're going to achieve our financial security. That's how we're going to be able to retire one day. That's how we're going to have an emergency fund, is we've got to save this money. But life gets in the way. All of a sudden, your kids need braces. Or my son had emergency surgery last year, right? And we didn't have, the insurance company doesn't want to cover it, right? So it's like, okay, now what do we do? How do you save money when life is constantly getting in the way? Well, most people, they don't save money because life is constantly getting in the way. Wealth growth without saving money starts with owning a home. Now, let me explain this to you. I'm going to give you a real life example right here. This is my house. I bought this on December 27th, 2006 for $899,000. Nice house, looks pretty good. We just listed it for sale for $1.5 million. Now, literally, you might even hear the echo because I'm in my office here and we've cleared out everything because we're in the middle of moving at the time I'm recording this here for you. So I don't know that it's going to sell for $1.5 million. I mean, in this market, it probably will. I have pretty good confidence that it will. But here's the key that I want you to understand. This will result in a gain of about $601,000 from what I bought it at. Now, if we were to look at that and split that $601,000 up over the last 16 years that I've owned the home, that's like getting a bonus of $37,562.50 for every year we lived here. Right? Just because I happen to live here. That was it. I bought the home and I lived in it. Now, here's what I want you to also understand. And by the way, that $37,000, I mean, what other way can you get a free $37,000 a year for 16 years? Right? There aren't a lot of ways to do that. This takes into account the crash of 2008. right? We bought it in 2006. The crash happens in 2008. Home prices start to go down. In fact, at one point, I think our home was worth probably in the 700s, and we bought it for $899. So, I mean, a couple $100,000 down, that can really hurt. But it kind of didn't matter to us all at the same time. And why is that? Because there's what we call the utility value of real estate. What that means is there's still a value in the real estate, even if it happened to go down instead of going up. I still needed a place to live. I was always going to have to pay for a place to live. If I rented some other place, it would have cost me the exact same thing that my mortgage did. I have a utility value in the real estate. So, I mean, really, if we were to count, what it went down to, and if we would have been lucky enough, let's say, to have bought the house in 2010 or 2012, oh man, our gain would have been even more than $601,000. But the point is, it kind of doesn't matter, because over the long haul, with real estate, you're in a really good position. And I want that point to really become very, very clear. The old false belief to a safe financial life is this: get a good college education, get a good job, set up a retirement account with a 401k or an IRA, and hope. How many people do you know that have failed following this formula? Almost everybody I know has failed. In fact, in my entire financial planning career, I had only 2 clients that were financially secure before they came to me. And one of them, it's because they were in real estate and they had a lot of real estate. The other one, I actually don't remember what they did to acquire their wealth, but they had already converted it if it had been in real estate. And they just needed to know how to make sure that it would stay and not go away. Basically, they wanted to preserve their wealth they had created. But most everybody else, that's the formula they follow. They get a good, safe job. Maybe they got a college education. They set up their retirement account. Maybe they're maxing out their 401k, and they're just hoping. And it doesn't actually work for them. Now, secret number 2 is the little known 5 financial advantages of real estate and how you can benefit. The challenge for many Americans is that they're only taught about saving money and what we call linear wealth growth. And they were never educated in how real estate wealth growth works. They don't know what they don't know. When I was a financial planner, I knew a ton about the stock market, retirement accounts, even how to limit or reduce taxation on your retirement accounts. But I didn't know what I didn't know. I didn't know what I didn't know about real estate. I didn't know about the 5 financial advantages. See, real estate can grow wealth and retirement income at 3 to 4 times the speed of the stock market. The 5 financial advantages of real estate are this: leverage, mortgage down or pay down, rental cash flow, tax benefits, and appreciation. Now, I'm actually going to cut away here because I want to actually show you visually how these things work in real estate. So let me go ahead and adjust my camera. All right, I think I got the camera adjusted enough, so hopefully you can see this here. Now, I've got some poker chips because I'm going to use these to help you understand the concept that I want to get across here. Let's say one of these black chips right here represents $1. So if we were to take $1 and stick it over in a savings account, then let's just say we get 1% on that savings account. Now, that would be a really great savings account in today's world, because I want to say we're getting, I think a 0.5% on our current savings account and like 0.1% on our checking account. We're not even getting that much. But one of these green chips right here represents the growth that we would get. Now, this is what we call linear growth, right? I put $1 into an investment savings account, whatever it might be, and I get 1 cent as my growth for the first year. I'm making money on the money, and that's the only way that I'm making money. Now, let's say we were to take $1 and we were to stick it into the stock market. Now, if we stick it into the stock market, let's say over the long haul, we get 8%. Even though that's not what they're predicting for the next 10 years, we'll get to that in a minute. But we're just going to say 8%. So 8 cents is what we're going to make. 2, 3, 4, 5, 6, 7, 8. Hey, you know what? We feel a lot better about that, right? Because we put our $1 in and we got 8 cents out of that thing. But now, what if we were to take $1 and buy real estate, but we were to buy $10 worth of real estate? So the bank gives us the other $9. And I'm not saying you even have to put 10% down, right? But I just want you to understand the concept. We took that same dollar, put it into real estate. The bank gave us $9 in real estate. And let's just say we made 5% in appreciation on that home. Well, that means we get 5% not on the dollar, but on the full $10, right? So we get 50 cents in appreciation. Make sure you can see this all here, because this is the important concept I want you to understand. $0.01 over here, 8 cents over here, 50 cents over here. But we're not done, because there's these other benefits, right? This is called leverage. We put down $1. They gave us 9. But then we're also going to have principal pay down. So what does that mean? That means as we continue to own the property, we're basically paying down that loan. Now, if this happens to be a rental property, then what that means is I'm getting someone else to pay down the $9 that we borrowed. So if someone else is paying what you borrowed and we're converting that, doesn't that mean that's free money? Doesn't that mean that didn't cost us anything to get that? But wait, our benefits keep going on from there. What if we have rental income that is above and beyond what it's costing us, above and beyond that pay down? That's another form of leverage that we've got, another financial advantage that we've got. Now, let's say, again, this is a rental property. Well, then we've also got the benefit of taxes. So we get something called depreciation. Now, if it's your primary residence, you get to write off part of your mortgage up to $750,000 currently, depending on your tax bracket, even your property taxes. But on a rental property, we get to write it all off because it's a business expense. And then we have this thing called depreciation, which allows us to write off even more. So it starts off with the leverage, right? The fact that we only had to put $1 down and we got the bank to give us the other $9. Then we had our mortgage pay down. We start converting that loan into principal dollars. Then we've got rental cash flow. Then we've got the tax benefits. And you've already seen the appreciation that we've got. But here's the coolest part. That's year 1, right? What's year 2? Year 2 is, you get another cent over there. You get another 8 cents right there. We grab a few more of these chips. On our appreciation, these might even be hard to see there on the screen. Sorry, I'm running out of room here. Right? But again, what's happening? We're still paying it down and converting more of that. And if we have rental income and we got tax benefits, do you see why I'm saying 2 to 3 times the growth of the stock market? 2 to 3 times the speed? What else can you do this with? There's nothing in the world you can do this with. That's why it's so incredible. All right, secret number 3, maximizing the safest investment you can make, which is real estate. Why most people fail financially is they rely on saving money and that linear wealth growth, right? We put $1 in the stock market, maybe we get $8 back. We put $1 in our savings account, maybe we get a penny back. I should say not $8, but $1, 8 cents, right? That's our 8% growth. $1 in our savings account, maybe we get a penny back at the end of the year. That's linear wealth growth. That's making money off of our money. Linear wealth growth is just making that money in the straight line. Or as I like to say, it's only making money on your money. Real estate grows wealth exponentially because of those 5 financial advantages and that utility value. Remember I talked about my house? Even when the stock market went down, there was still a utility value, or the stock market, even though the stock market did go down, the housing market went down in the crash of 2008, there was still the utility value of my home. I still needed a place to live. If I had been renting out my home, somebody still would have needed a place to live. They would have kept paying rent. In fact, we started to see rents go up during that time because of the fact that so many people were leaving their homes and now they had to go rent somewhere. So rents actually went up. Real estate is safer because its growth operates on 2 separate supply and demand components. People still need a place to live. Now, I'm going to show you some data here for California. And just know that what I'm talking about today, I do primarily in California and Texas. And the main reason is those are 2 of the best states to do this in. But a history of California rents, you can see those lines right there on the graph. Right? We see the blue line and the green line, and they're really, really steady, and they're just kind of going up. Now, they do have a small little dip there, but they go up for the most part. And what we know is that we look at these numbers here, the 3-year change for the U.S. median gross rent is up about 6.82%. In California, it's more than that, right? It's about 12%. So what this means to you is that on average, we're seeing about a 4% growth rate in rental income year over year. Now, if inflation is running you at 3% or slightly over 3%, then that means we're able to keep pace and slightly edge out inflation just by the mere fact that we get to raise the rents every year to still be in line with what's acceptable in our environment, in our state. That's really good to know. Now, the history of California real estate prices, I'm going to take you through this here, 1968 all the way through 1990. So we look back at 1968, median home price was $23,210. Now, don't you wish you could have bought about every home you ever saw back in 1968? Median income in the U.S. was, median not income, but median home price was $20,100. So it's slightly higher here in California. By 1990, that same $23,000 median home was $193,770. That's a huge jump up. Huge jump. Median home price in 1990 for the entire U.S., $97,300. 1990s, we had in California, we had a lot of things change. Cold War ended. We saw a lot of the defense contractors move out. So we had real estate kind of dip down. But even then, again, real estate has that utility value. So whereas the rest of the country didn't have that going on, California did have that going on. However, what ends up happening is, again, everyone wants to move to California. So eventually we see everything come back up again to the point that in 2010, remember that $23,000 home? It's now $305,000. Whereas the U.S., that $20,000 home for the median in the U.S. is now $173,000. So is it good? Has it gone up? Yes. In California, it's just done exceptionally well. As we start looking here over our recent years, that same $23,000 home back in 1968 is worth $659,000 in the U.S. or in California today. That's really, really powerful to really understand how appreciation in real estate works. The average annual appreciation rate for 54 years in California is 7.3%. See, market timing doesn't make any sense. We don't know what's going to happen tomorrow. We don't know if the housing market's going to go up or down. It's about making the best buy possible in any market, and then having that utility value that allows us to rent it out. So no matter what happens with the ups and downs, we're covering our bills. And eventually, we know we're going to be in a great position. So how to build that $10 million net worth. I'm going to show you some examples here of what can be done. And now, this presentation was done a few months ago when rates were different. So rates are different today, right? So we use the 3% interest rate. Today, they're about 5%. And tomorrow, who knows what they'll be. It's the concept I want you to understand. It's the concept I want you to focus on. So let's say in 2022, you purchase your investment number one. We're going to call it our new primary residence. So let's say you don't own any real estate. Home purchase price, $750,000. You put 5% down. That'd be $37,500. We have a 3% interest rate. We've got closing costs on the home. Total investment is just shy of $50,000. We've got our what's called principal, interest, taxes, and insurance payment of about $4,200 a month. Now we've got that home, and based on the average growth of California real estate over the last 54 years, that $750,000 home in 5 years is going to be worth $1,066,000 and change. The equity that you're going to have in that home, remember the first year you put down 5%, $37,500. But now, because of principal pay down and because of the appreciation, you're going to have about $433,000 of equity in 5 years. I want you to really understand this here. What other way can you acquire $400,000 without saving any money? You were going to have to pay rent or pay a mortgage anyway. So you did that. But now you end up with a bonus. Now, investment number two, in 2026, you sell that home that was worth $1,066,000. You're going to purchase investments 2 and 3. So you're going to purchase a new primary residence that you're going to live in, and you're going to buy your first investment real estate property. So because things are going to be more expensive in a few years, you got $1 million purchase price. Now you put down 10%. Interest rate we're using here is 3.25. Again, rates will be different as they're already different today. $15,000, $522 in closing costs. Total investment, $115,522. Your new principal and interest, taxes, and insurance payment, $5,409. Now, what's probably happened over 5 years? Your income's gone up, right? So that's not really a big shocker. Now we take a look at that property, that $1 million property. 20 years out, that property is going to be worth just over $4 million, almost $4,100,000. Your loan balance in 20 years is going to be $400,000. The equity that you've got in there is $3.6 million. $3.6 million, and you didn't have to save any money. You just paid your mortgage. That's pretty crazy, isn't it? Now, if you were to rent out that home, you'd be renting it out in 20 years for about $9,202. And you go, no, that's crazy. No, that's actually in line with what rents are doing. Rents keep going up. And you can see in our little compound rent revenue column, you can see they start out at about $4,200. And then just based on 4% growth in rent in 20 years, that's $9,202. That's what happens. So now let's take a look here. We sold investment number one, and we're going to now purchase 2 units, right? So this is still 2026, right? We just sold our first primary residence that was worth $1,066,000. We bought our new primary residence now for $1 million, and we're going to purchase 2 units for $1 million. So this is a duplex. We're going to put down $250,000 because remember, we had about $430,000 from our first home that we sold. So we use 100,000 of it for our new home, and we're going to use 250,000 of it for our investment property. Closing costs, all that, we're at $264,000. All of this is being done because of the real estate that we sold. Our principal, interest, taxes, and insurance payment is around $4,660. Our rental income is actually a positive here. We're up about $800 to $900. We're at $5,500 over what it's costing us. So it's actually starting to put money in our pocket. Now, remember, I also said the other home, our payment's gone up. Well, we're also offsetting that with the fact that we've got this rental income coming in. But what happens to that property? That $1 million property in 5 years is now worth $1,400,000. You owe $672,000 on it. That means you've got almost $750,000 of equity. Now, your rent at that point would be $6,000, almost $700 a month. And remember, over here, it's costing us $4,660, right? So we're making a couple of grand a month here off of this. Well, we're going to sell that, or we're going to exchange it. It's called a 1031 exchange. And we're going to purchase 5 units now. So this is 2031. That's the year it is. We're going to purchase a $2.5 million property. We're going to put down $625,000, 25%. How do we do that? We did that from the money, the profit that we made here off of the duplex. Our interest rate's at 4%. Our closing cost $33,000. $658,000 is total what it's costing us here. Our principal, interest, taxes, and insurance payment is about $12,200, just slightly under that. Our rental income is going to be slightly over that, $12,500. So we're actually getting someone else to pay down our property. You understand that? You with me so far? So now those 5 units in 5 years are worth $3.5 million. We owe just shy of $1.7 million on it. That leaves us with $1.859 million of equity. Now, our rent at that point would be $15,200. So we're going to be making, again, $2,500 a month. But what if we were to sell that in 2036, 5 years later? And now we're going to buy 10 units. So now we've got a $6 million purchase price. We got to put down $1.5 million. But again, we're doing that from our 5 units that we just sold. Our closing costs are $78,000. Our total investment is just under, $1.6 million. Our principal and interest on that is going to be $30,551. Our rental income, though, is going to be significantly more. It's going to be about $35,000 a month. So that means we're going to be making about $4,500 a month off of this. And we hold on to that. 10 years later, what's happened? 10 years later, that home is now worth $12 million, or those 10 units, I should say, are now worth $12 million. We owe $3.6 million on it. That leaves us with $8.5 million in equity. So remember, this is all about how do you build a $10 million net worth? Well, by the year 2046, your primary residence is worth that almost $7 million. You've got a net cash flow out of zero because you live there, but you got those the 10 units that you have a net worth of $8.5 million, and they're cash flowing $18,000 a month. So your total net worth is actually more than 10 million. It's $12,225,000. And an income, a positive net flow income of $18,646. And you didn't save any money. All you did was pay your mortgage, which is what you would have done anyway if you were renting. You understand the point here? You understand why I look at this and I go, this is so much better than the stock market. You can't do this with anything else in the world. Real estate's the only thing that allows you to do this. Now, here's the interesting thing. Goldman Sachs, They're known as one of the best market research companies out there, along with everything else they do. And so their economists, one of the things that they talk about all the time, the housing shortage, prices, rents, deregulation, and basically they're expecting home prices to continue to go up. Even now, even with interest rates going up, they're saying it's going to go up slower, but they're still going up because of supply and demand. In fact, the Financial Samurai guys, they had an interesting article. Our long-term value model indicates negative returns for the S&P 500 over the next decade. Now that happened in the stock market from 2000 to 2010. It's known as the lost decade, where the S&P 500 didn't go up. And that's because of the crash we had in 2008. And they're looking at that going, we think that's going to happen again over the next 10 years. And the interesting thing is this isn't too far off from what Vanguard forecasted. Now, Vanguard, if you don't know, they are one of the largest mutual fund companies in the world, money managers. They were seeing, hey, you know what? We think over the next 10 years, there's only going to be about a 4% return on stocks over the next 10 years, which is basically saying maybe keep pace with inflation. And if it ends up being a lost decade again, you're going to lose money to inflation. Now, right now, inflation is significantly higher than 4%, but it's not going to stay up that high. I mean, they're doing things now to lower inflation and all that. Here's what you need to know. It's not about market timing. It is about finding the right deal. And the right deal is in the numbers. It's always in the numbers. In fact, location matters, but the numbers matter more. So here's what I want you to take away from this presentation today. Financial security is a choice. You can choose to say, hey, I'm going to do what it takes so I can become financially secure. Or you can say, you know what? I'm going to do the hope model. I'm just going to hope and pray that one day I become financially secure. Or you can say, you know what? I'm going to take control of my future and make sure that I'm financially secure. Here's your path to financial security. Replace your employment income with passive income that will never run out. That's the whole key here. It's not about getting the next great job. It's about passive income and having that income come in month after month. Invest in real estate. First, invest a home for yourself, then passive income producing rental properties. That's the whole strategy. And if you've already got a home, great. You're already, halfway there, if you will. If what you've seen today makes as much sense to you as it does to me, then here's the next step for you. I want you to go to speakwithpete.com for an informal chat about how these concepts can work for you. Now, here's what I want you to know if you decide to do this. We're just going to have a chat on the phone or Zoom. I usually prefer to do it on Zoom. There's going to be nothing to buy on this call. I'm not going to sell you anything. I'm not going to be asking for your credit card. I'm not going to be asking for your social security number or any other private information. This call is only to discover if and which strategy is right for you. Now, why do I say which strategy is right for you? Well, if you are 30 years old, you're going to need a different strategy than if you're 40 or 50 or 60. See, you might have different goals. Like if you're 60 years old and you're like, look, I need to figure out a way that I can increase my income by $2,500 a month. We've got to do a different plan to get you that than if you are, like I said, 30 years old and you're like, hey, you know what? I got 30 years before I need to retire. But hey, if I could become financially secure in 15 to 20 years, so by the time I'm 50, I wouldn't be opposed to that. What's the plan for that? Then we build the plan for that, right? So it's not about, is there a magic strategy? It's going to be different for everyone based on their goals and where they're at currently, and also their age, risk tolerance, all that stuff. Another thing I'll say is you must be looking to buy/invest in California or Texas. Why? Because those are the states that I focus on. And most importantly, for us to have this call, I ask that you be an action taker. If you're not an action taker, if you know, hey, you know what, I just like to collect great information, then, just take what you've learned here today and go ahead and do what you want to do with it. But I want to talk to people who are ready to take action. Now, if after we talk, it makes sense to you, what we're going to do is we're going to get you approved on the financing side of things. I have a team that I'm going to have you work with. And then we're going to go over how to best purchase your new real estate, whether it's your primary residence or whether it's an investment property. We're going to go over the best strategies for you to do to make that actually happen for yourself. So that's why I say it's a totally informal call. I'm not asking for your information. I'm not asking for any of your personal stuff. I'm not getting you approved for a loan. I'm not doing anything like that on this call. After we talk, if it makes sense to you, then I'll have you take the next step with my team. So again, what I want you to do is go to speakwithpete.com. Go ahead and do that right now. Get on my calendar. Let's have a chat and let's see what makes sense for you. Thanks so much for your time. I appreciate it greatly. Again, go right now, speakwithpete.com. Let's have that chat. I'll talk to you soon.